Welcome to The Explainer. Today, we're talking about a market that is literally holding its breath. I mean, investors are basically frozen, waiting for what might be the most critical decision of the year from the Federal Reserve. And you can just feel the tension.
Okay, so let's get right into it. The entire market is stuck in this holding pattern, right? It's caught in a massive tug-of-war between hope, fear, and some seriously confusing data points that are pulling everybody in opposite directions.
To really get a handle on this tension, you've got to start by looking at the scoreboard for the day. It tells the whole story of a market that just can't make up its mind.
I mean, look at this, it was a completely mixed day. The S&P 500 basically went nowhere, just flat. The Nasdaq, it eked out a tiny gain, mostly thanks to a few big tech names. But then you have the Dow, which got dragged down by one company's bad news. What does that tell you? It's a market with zero direction, just waiting for some kind of signal.
Now, the big fear haunting investors right now is this idea of a hawkish cut. So what does that even mean? Well, it's the worry that even if we get the rate cut everybody's been hoping for, the Fed's message is going to be, hey, don't get too excited. This isn't the start of some big cutting party. It's kind of like getting a present, but being told you can't really play with it yet. And you can see that nervous mood perfectly right here. The VIX, the market's fear gauge, it's up there, showing there's some real anxiety. But look at the fear and greed index. It's not flashing extreme fear or extreme greed. It's just sitting right in the middle in this cautious wait-and-see zone. Nobody is making a bold move.
Okay, so while the overall market seems quiet, if you look just beneath the surface, wow. Individual company dramas are creating these huge waves, and that's where all the real action is.
So check this out. Take NVIDIA. They got the green light to sell their super powerful H200 chips to China again. On paper, that sounds like amazing news, right? But the stock actually fell. So what gives? Well, nobody has a clue if China will actually buy them, since Beijing is so focused on building its own tech. It's a classic case of good news just hitting a brick wall of uncertainty.
And it's not just tech. You've got these two totally different stories playing out. JP Morgan stock got absolutely hammered because of an internal shock. They put out a forecast for soaring costs, and it just spooked everyone. Meanwhile, you have Paramount making this massive, aggressive gamble to buy a rival. It just goes to show you, right now, it's a total stock picker's market. Individual company news is everything.
So with all this corporate news pulling the market every which way, all eyes are turning to the economic data. This is what investors are digging through, looking for any kind of clue about what the Fed's going to do next.
And today, we got a huge one. The JOLTS report showed more than 7.6 million job openings back in October. That is way more than anybody expected. Now, this points to a really strong, resilient economy, which, funny enough, is actually bad news if you're hoping for rate cuts. A hot economy gives the Fed way less reason to step in and help. And you can see how the bond market reacted to that jobs data. Both short-term and long-term yields ticked up. Now, why should you care about that? Well, think of higher yields as gravity for the stock market. They pull money away from stocks and put a ton of pressure on the whole market, especially on those high-growth tech companies. So when you mix all this stuff together, the strong jobs report, the wild company news, you end up with this really clear split in the market. The energy sector was the day's big winner, thanks to a great forecast from ExxonMobil. And on the flip side, the financial sector just took a beating, dragged down almost entirely by that JP Morgan cost news.
Okay, so that's all the short-term anxiety and chaos. But let's just zoom out for a second and look at what the experts are actually forecasting for the longer term.
And you know what? The consensus is surprisingly bullish. You've got major firms like Oppenheimer calling for the S&P 500 to surge way higher into 2026. The common thread here is this belief that the whole AI-driven rally is about to enter a brand new phase. The idea is it's going to move beyond just a few tech giants and spread to what Morgan Stanley calls the AI adopters all across the economy.
So all of this brings us to the million-dollar question, right? For anyone with money in the market, how in the world do you navigate this tense, uncertain environment?
Well, you basically got two very different paths you can take. The aggressive strategy is a bet on that bullish long-term outlook. You're betting that AI adoption is going to spread, and that when rates finally do get cut, it's going to give a huge lift to smaller companies. Then there's the conservative strategy. This one assumes all this uncertainty is going to stick around, so you focus on defensive sectors like energy and utilities that can, weather the storm with stable cash flow.
And so that's where we stand. The market is truly balanced on a knife's edge. It's like a coiled spring, wound incredibly tight by conflicting data, by corporate drama, and by this massive weight of expectation for what the Fed is about to say. The only question left is, once the Fed finally speaks and all that tension is released, which way is this thing going to jump?